As oil prices climb above the $100 mark once again, market expectations regarding the systemic risks posed by the Iranian geopolitical conflict are intensifying. In the absence of an effective and complete resolution to the crisis in the short term, news-driven developments remain the primary driver of market action. Nonetheless, the interest rate decisions from various central banks this week cannot be entirely overlooked. Asset price volatility is likely to remain at elevated levels throughout the week. Last week, President Trump rejected proposals from several Middle Eastern nations to initiate ceasefire negotiations with Iran. The U.S. has signaled that its current priority is to sustain military operations in order to further degrade Iran's military capabilities. Consequently, how this situation evolves remains the top priority for the market this week. In addition, the Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan are all scheduled to release their interest rate decisions this week. Markets are closely monitoring the potential convergence of the Fed's dot plot regarding rate cuts, as well as the suspense surrounding a possible rate hike by the Bank of Japan. At the same time, the central banks of Australia, Indonesia, and Brazil will also be issuing statements in succession. This will provide a primary opportunity to compare the monetary policy divergences among these different central banks. WTI crude oil experienced broad-range volatility last week, hitting a high of $119 and a low of $76, primarily driven by news flows surrounding the situation in Iran. The appearance of a large doji on the weekly chart typically suggests that the market will require a period of consolidation and repair before entering a new phase of the trend. Consequently, the aforementioned price range is expected to hold in the short term. Clearly, an end to hostilities would drive oil prices lower, whereas further escalation would intensify the rally. While both risks currently appear contained, sustaining prices above $80 will impact inflation over the medium to long term and eventually transmit throughout the entire financial market. The longer oil prices remain elevated, the greater the overall pressure on the markets will become in the future. Gold closed down approximately 3% last week. Following a medium-sized bearish candle, the metal has shown weakness for the second consecutive week. At the market open this week, gold prices further broke below the $5,000 mark, suggesting persistent downside pressure and the risk of further declines in the short term. The Middle East situation has acted as a headwind rather than a catalyst for gold, leading to a decline in investor enthusiasm for the metal in the near term. However, consistent with previous assessments, gold inherently requires a period of consolidation. Thus, the ongoing tug-of-war between bulls and bears is to be expected. On the downside, solid technical support remains at the $4,800 and $4,640 levels. Should a rebound occur, bulls will once again face suppression and challenges at $5,142 and $5,342. In the short to medium term, gold is likely to require more time to complete its oscillation within the broad $5,600 to $4,400 range. The US dollar surged last week, returning above the 100.00 psychological milestone. In the short term, the oil crisis has unexpectedly become a lifeline for the greenback. From a chart perspective, the battle for control within the current price range is critical. If the index can effectively consolidate above 100.42, a potential large double bottom structure will emerge, with a theoretical bullish target pointing toward the 104.00 level. Regarding potential retracements, the repeated appearance of lower shadows on the daily chart last week suggests that buying pressure remains resilient. Consequently, significant support is expected to be found at the 99.00 and 98.00 levels. U.S. equities delivered a poor overall performance last week. The S&P 500's midweek rebound failed, not only leaving behind a prominent upper shadow but also closing near its weekly low. Coupled with a 3-week losing streak on the weekly chart, the risk of further short-term downside is intensifying. The area around 6,520 is a critical support level. A breach below this point would, at the very least, allow bears to seize the upper hand in the short term. The high at 6,845 remains the primary resistance level for any potential rebound. As long as high oil prices persist, it will be difficult for U.S. stocks to quickly return to a secular slow bull structure. Bitcoin performed well last week, surging over 10% in a single week and nearly engulfing the entirety of the previous week's upper shadow. Amid the weakness of other risk assets, this price action in crypto suggests, on one hand, that the probability of the crisis escalating further is limited. On the other hand, it indicates that assets like Bitcoin and Ethereum inherently possess the need for a rebound and technical repair. The $74,000 level will be the first major hurdle, followed by a potential pullback test of the $80,000 level. For the bears, only a break below the $60,000 low would signal the start of a further decline.